He kōna ipurangi tēnei nā te reo irirangi o Aotearoa.
What are the tax implications of buying a house overseas? Is it a waste that most people don't get an inheritance from their parents until they're past the point of needing it? What actually is the OCR anyway? And can financial advisors who are paid on commission be objective? That's some of what we're tackling on this week's episode of No Stupid Questions. I'm Susan Edmunds, RNZ's money correspondent. I'm joined by Justin Gregory.
How you doing, everyone? Looking forward to getting into it again.
Just a reminder that while we often get some quite specific questions from people who want to know about their own circumstances, you can send us really broad ones too. So if you've had something on your mind for a while, send it over to us at questions@rnz.co.nz.
So, to start, we're going to go to something pretty topical, the official cash rate. Neve in Whangarei wants to know what it actually is and why it matters so much. Fair question there, Neve.
Yeah, that's right. The Reserve Bank's been looking at the rate again for its February review, so it is topical. In very basic terms, the OCR determines what the Reserve Bank charges your retail banks to borrow and what it pays them when they have deposits with it. So when the OCR goes up, the banks have to pay more to borrow money from the Reserve Bank. It's one of the things that influences their cost of funding. Other sources like wholesale markets and customer deposits can be influenced by the OCR too, as well as where wholesale markets think the OCR is going to go into the future, which can get quite, circular, and we go round and round saying, where do we think it will go? And the Reserve Bank has to kind of pull the market in sometimes when it gets carried away.
Right, okay, but then why does it matter? Why does the OCR matter to anybody?
Well, the Reserve Bank uses the OCR to basically slow the economy or speed it up. If it thinks inflation's getting too high, like we saw after the pandemic, it can ramp up interest rates, so we all have to spend more money on our debt, which is very boring, and we have less money for other things. So businesses can't put up their prices so much because no one has the excess money to spend. Business loans are more expensive, so there's less room for wage rises, all that sort of thing. We saw that crunch hit hard in the past few years. And when the economy is slower, the Reserve Bank can release that OCR pressure and give us a bit more room to move, which is what we've seen more recently. And when it's really worried about the economy, it can take the OCR way down to make it much cheaper for individuals and businesses to borrow and buy or invest. So that was what happened during the real COVID years when we went down to 0.25%. And in retrospect, we probably stayed there a bit too long.
Maybe a bit too long. Hope that's been helpful, Neve. On to the next question. Now, we've got a question here from Natalie, who says she's trying to help her mother live autonomously and needs to buy her a flat overseas. She wants to know what happens with tax. Will she be able to get a loan in New Zealand to buy offshore? And would a property in New Zealand be a good asset against a mortgage or a loan to buy abroad? Natalie says the plan is for the seller, her mother, to transfer ownership and receive an initial cash sum and then a monthly pension until her mum dies. And then her mum would also be able to use the flat, but she could also rent it out if she decided to go into a rest home for seniors, and, that would give her the means to do so. All right,
yeah,
Susan?
There's a lot going on here.
Go for it.
So we won't get into whether this is the best arrangement to help her mother because we don't have all the details. But in terms of the tax, Robin Walker at Deloitte says every country has different laws that could apply in this situation. So it's worth getting really specific advice for the country that her mother is in because we don't know which country that is. She says in many cases there may be capital gains taxes if a property is subsequently sold for a gain and you as the owner won't be living in the property. So you might not qualify for any CGT exemptions, such as, the main home exemption that we have in New Zealand. So depending on the country, there may also be stamp duties, land taxes, and other charges associated with purchasing the property.
Sorry, just very quickly, CGT is what again?
Capital gains tax.
Of course it is. Thank you. Please carry on.
We'll probably hear more about that coming into the election. She says New Zealand residents are taxable on their worldwide income and they're entitled to take deductions for the costs of earning that income. But she says it's not clear here whether you will be actually getting any income from this, so there might be no ability to structure it to claim tax deductions on your mortgage interest or other costs. But if you are going to be charging rent, then you'll need to make sure it's all at market value. Robin says if you're earning some form of rental income in another country, that other country might also want to tax that income, and you'll need to then consider whether there's a double tax agreement with the country, which will determine which country has the right to tax you, and file tax returns in the other country as well as New Zealand. So that's quite a lot to get your head around.
Get a professional in, is what I'm getting from that.
Yeah, definitely go and get some advice on that bit.
Yeah.
And as for the borrowing side of it, mortgage advisor Jeremy Andrews at Key Mortgages tells me that there could be ways to do this. He says you could look at an equity release against your New Zealand property if your income and equity are sufficient. He says there are a few options, but it's the kind of thing you probably need to seek advice on, again, that's specific to your circumstances.
A kind of related question, also about helping family, but sort of the other way around. Ronald says he has 3 grown children, all with different circumstances. Ronald says, I think that inheritance comes too late in most people's lives. This happened to me. My children are, says Ronald, my children are at a stage when they are setting up their homes, bringing up their children, education, etc., and they're working hard to cover expenses, and this is when they tend to need cash flow assistance. However, in my case, says Ronald, it looks like my kids won't get their inheritance for quite a few years. Good on you, Ronald, hang in there. And by then, hopefully, they won't really need an inheritance. Seems all back to front to me, says Ronald, and my kids agree. What do you think, Susan?
My initial reaction to this was, yes, I do think people often get an inheritance, if they get one, when they're old enough that they don't really need it as much anymore. But also, it's not really an easy thing to change, is it? Because generally, for most people, I think if your parents are around through more of your life, then that's probably a good thing, as long as you've got nice parents. Liz Coe, who's a retirement specialist at Enrich Retirement, says there are a few things people can do to help their kids, though. She says the first one is to help them learn how to manage their money. So giving them handouts when they run out does the opposite of this, she says.
True.
I think that's quite a hard message for teenagers to hear, though. Help them buy their first home to the extent that they need help, she says. And if and only if the above two have been achieved, she says, if you feel you have more money than you need in your lifetime, you can give them an advance inheritance.
Because that's the crucial thing, isn't it? Money in your lifetime. You can't go giving away your cash that you need to live on before you die.
Yeah, that's right. Because if you give them all your money and then you have to live in their garage or something, they might not be that happy about it. But she says she recommends getting legal advice on gifts to children because there can be issues around relationship property. You don't want to see half your gift disappear with an ex-partner of one or more of your children, for example. She says you should also ensure you treat your children equally or at least fairly and transparently so there are no arguments over your will when the time comes.
Good advice.
I think they could give us some more questions, though.
Equally
but she says
or
when you
fairly.
give money...
Equally or fairly. Yeah, discern that one.
Yes. She says when you give money during your lifetime, be absolutely sure you have enough for your own needs first. She says, I would not recommend using your home as security to help your children. If you are in the situation where you don't have enough liquid investments on hand to help them, then you probably can't afford to help them. So there you go.
True.
On a semi-related note, I've recently been really impressed by what my son's learning about money in school this year. He's a year 7 and they have a dedicated personal finance class. And he told me he's discovered his money personality is socialite, which apparently means he likes to have a nice time with it. I thought that's very funny. But good news that maybe the next generation's going to hit adulthood with a bit more money confidence, maybe.
Time for a question about insurance. Julia says, I have owned a 1930s 2-storey brick house for 25 years. It is in 2 flats. I live in 1, says Julia. The current mortgage is approximately $130,000. My house is on reconstituted land and deemed flood prone. To date, it has not experienced flooding. I hope that's still true as of the news this week. My concern is that the insurance company may in the future not renew contracts, as is happening on the West Coast. Yeah. It's a condition of the mortgage that the property is insured. Have banks indicated what course of action they would take in this eventuality? Good question.
Yes, I talked to Consumer New Zealand's insurance expert Rebecca Stiles about this. She says a house insurance contract is just for 1 year, so technically an insurer could refuse cover when the policy comes up for renewal, or they could adjust the terms of the policy to reduce the financial risk in insuring it, and that could potentially mean lesser cover and higher premiums, which would be bad news. She says from her research she thinks banks are aware of the issue of underinsurance or people not renewing insurance contracts when they still have a mortgage, but there doesn't appear to be a mechanism in place for banks to check that mortgagees still have insurance. In a Reserve Bank stress test, it found that banks weren't tracking the insurance cover on the homes they had mortgaged, and it recommended the banks find a cost-effective way of doing so.
That's a bit of a gap, isn't it? A bit of a gap in knowledge.
Yeah, it does seem like it potentially a bit of a concern. She says banks are assessing how many mortgaged properties on their books are at risk of flooding. And when people take out a mortgage or refinance, the cost of insurance and the cost of lending are taken into account. Whether banks can come up with a cost-effective way to monitor insurance coverage remains to be seen, she says. If they do discover homes that aren't insured, it will raise further questions. And then we'd have to think about things like, would the onus be on the bank to arrange insurance for their customer? Would the insurance be affordable? And would those steps place more financial stress on the mortgage holder? So it's definitely something a lot more people are becoming aware of and a bit of a concern. I think you can get natural hazards cover if you can't get any other insurance, but that's definitely like a last resort option.
Okay, Rebecca, a different Rebecca from Rebecca Stiles, wants to know how to find a financial advisor who will give independent advice. Rebecca, not Rebecca Stiles, says, I'm reasonably happy with my financial plans, but it's always good to check with an expert. However, I know many advisors are remunerated through commissions and therefore are only going to recommend products or providers that pay them. Rebecca says, my current investment plans mainly revolve around low-fees broad market index funds, so I'm worried by seeking financial advice someone will try to steer me away from this and towards higher-fee, actively managed products because of commission. I want truly objective advice and to not be suspicious of what's in it for the advisor. Is this a real problem, Susan?
Well, it is true that most advisors have historically been paid by the product provider that they put their clients with. And that's because generally people haven't wanted to pay for the advice and the advisors need to be paid somehow. But there are a few who are paid by fees from the clients instead, and that could be something that Rebecca could consider. You might, pay for an hour of their time or for a plan or for ongoing investment monitoring. That's another thing that they charge fees for. But all financial advisors have to meet certain disclosure rules anyway. I talked to Financial Advice New Zealand Chief Executive Nick Hakes about this.
All financial advisors have disclosure requirements, so they need to explain clearly to any client how they charge, what they get paid, what the scope of advice is. And so there are disclosure obligations on all advisors. And my encouragement to any client seeking a financial advisor is go with a whole list of questions. So not just about how they might be remunerated, but importantly, have they helped someone in similar circumstances to you? And how did they help? And so, the remuneration method is just one of a series of questions which all clients should be asking financial advisors. And I would strongly suggest that they go to the Financial Advice New Zealand Find an Advisor directory, because all advisors on that are members of the professional body.
That was Financial Advice New Zealand Chief Executive Nick Hakes.
Now, over the last week, Susan, you've been looking at car insurance quite a bit. What's going on with that then?
This is the story that never ends. I feel like every time I write a story about this, someone else emails me and says, it's happening to me too. But it started with someone who told me she was surprised when her car, which was more than 20 years old, was suddenly deemed by AA Insurance to be worth 2.5 times more this year than it was last year, which is strange because usually cars don't increase in value.
They don't,
And then
no.
more people got in touch. Yeah, and they were saying their values had increased wildly or decreased massively just in the year. And AA Insurance says it relies on third-party data providers to guide valuations, and every so often there might be a data or methodology change that can cause a big swing. So I guess that's what's happened here. But, it's a reminder that it's always a good idea to read your insurance documents, make sure you understand what you're covered for, how much cover you've got, all that sort of thing.
And that leads us very nicely to the listener question for this week. We know car values can vary wildly, sometimes within your insurance policy, but what was the average car value 40 years ago, Susan?
Let's say in 1983, because that's the year that I was born.
And it keeps us on our 1980s theme because last week we asked you what the median house price was in 1981, which was the first year that UB40 visited New Zealand. Susan, how was the UB40 concert you went to recently?
It was a UB40 concert in Whangarei, so I imagine you could probably picture it. The answer is about $40,000. New Zealand's median house price increased almost 18 times between 1981 and 2019.
So maybe UB40 should have bought a house in New Zealand on that tour. Would have had a nice thing to come back to this year.
Send us your thoughts, worries, questions, answers to questions@rnz.co.nz. No Stupid Questions with Susan Edmunds was written and presented by Susan Edmunds, that's me. Justin Gregory is the producer, the engineer is William Saunders. Thanks to Neve, Natalie, Ronald, Julia and Rebecca for their questions, and Robin Walker, Liz Coe, Rebecca Stiles and Nick Hakes for their answers. Follow and listen to No Stupid Questions with Susan Edmunds on Apple Podcasts, Spotify or any podcast app so you don't miss an episode.